You can be the finest stock picker in the world and still go bankrupt. You can find a company with revolutionary technology, flawless earnings, and visionary leadership, buy its stock at what seems a perfect price, and watch in horror as your account is systematically dismantled. The reason is that you have made the single most catastrophic error a speculator can make. You have mistaken the behavior of a single stock for the behavior of the market. You have ignored the general conditions. A stock, no matter how magnificent, is merely a cork bobbing on the ocean. It is the tide, the great underlying current of the market, that determines its ultimate direction. You can paddle a canoe with all your might, but you cannot paddle it against the pull of the Niagara. To try is financial self-destruction. This is the first and most foundational law. You cannot win if the market is against you. My entire career was a painful, expensive education in this one truth. I learned it early in the bucket shops, the primitive, unregulated brokerages of my youth where you bet against the house on fractional price movements. There I was only concerned with the wiggles, but when I came to New York with my pockets full, I discovered a different game. It wasn't about the eighths and quarters anymore. It was about the great multi-point swings. And those swings were governed by a force I did not yet respect. I remember with perfect clarity my experience with Union Pacific. The stock was falling from a great height, and I knew, based on my calculations and its intrinsic value, that it was a buy. I stepped in and bought it. It kept falling. I bought more, convinced of my correctness. The market continued to prove me wrong, taking my money with each tick down. My analysis of the stock itself was not incorrect in a vacuum. The problem was that the entire market was in a state of decline. The line of least resistance for everything was down. My stock, as good as it was being carried out with the tide. I was right, but I was wrong at that time. And in speculation, being early is indistinguishable from being wrong. The market is never wrong. Opinions often are. You do not get paid for stubbornness. I fought the tape, and the tape, as it always does, won. It took a significant portion of my capital to learn that you do not argue with the inevitable. Your job is not to impose your will on the market, but to discern the market's will and align yourself with it. Before you even consider a ticker symbol, you must first become a diagnostician of the entire market. Is it in a bull phase or a bear phase? Is the path of least resistance upward or downward? Do not place a single dollar at risk until you have answered this question with confidence. To do otherwise is to gamble, not speculate. The second law follows directly from the first. Once you have a diagnosis of the general market, you must confirm it by checking the leaders. An army does not advance with its supply clerks and medics in the vanguard. The generals and the elite shock troops lead the charge. It is the same on Wall Street. In any great market movement, a specific group of stocks will assume leadership. It may be the railroads, the steels, the oils, or in your modern era, the technology issues. It does not matter which group. What matters is that you identify it. These leading stocks are the barometers of the market's health and intention. They are the first to break out to new high ground in a bull market, and the first to show signs of weakness at the top. Their action is the clearest signal you will ever get. When I suspected a new bull market was beginning, I never bought a basket of laggards or cheap, beaten-down issues. That is the amateur's mistake, confusing a low price with a good value. Instead, I would test the market by making a probe into the leaders of the day. I would buy a small lot of the 2 or 3 strongest stocks in the most powerful group and watch their behavior. Did they advance easily? Did volume come in to support the price move? Or did they feel heavy, struggling to rise and falling back on light selling? The response of these leaders told me everything I needed to know about the entire market structure. If the generals charged forward, I knew the army would follow, and I could begin building my full line with confidence. But if the generals hesitated or retreated, I took it as a grave warning. It was the signal to pull back, to move to cash, and to wait. The failure of the leading stocks to lead is the market's way of telling you that the bull campaign is faltering. This is precisely how one spots a top. Long before the broad averages roll over, the leaders will stall, they will churn on heavy volume without making progress, and then they will begin to break their uptrends one by one. Ignore this signal at your peril. Jesse Livermore consistently stressed that Wall Street extracts a heavy cost of instruction for every lesson learned the hard way. Fortunately, the core principles he developed to survive these expensive market penalties were captured for posterity by Edwin Lefebvre in the 1923 masterpiece, Reminiscences of a Stock Operator. It stands as the finest possible literary training ground, allowing you to absorb decades of painful operational experience without ever having to risk $1 of your own capital. To ensure this timeless wisdom translates accurately to the modern computerized arena, we advise seeking out the Max Davidson Annotated edition. Davidson's careful commentary is indispensable for bridging the gap between Livermore's era and ours. A link to this essential edition is provided in the description below. The third law of general conditions is one that is often overlooked because it is not found in the price charts. You must check the condition of the credit markets. Speculation runs on money. Not just the money in your account, but the great river of credit that flows through the financial system. A bull market cannot exist, it cannot even begin, without an abundance of cheap and easily available credit. When money is easy, speculation thrives. When money becomes tight and expensive, speculation withers and perishes. It is the oxygen supply for the market. I learned this lesson most vividly during the period leading up to the Great Panics. Before the panic of 1907, a man could feel the tightening in the money market. The rates for call money, what brokers paid to borrow for their clients' margin accounts, began to rise to extraordinary levels. This was a signal clearer than any ticker tape, which in your time is the live streaming price feed. It meant that the well of credit was running dry. The speculators who had been extended enormous credit to hold their stock positions were suddenly being squeezed. They would be forced to sell, not because they wanted to, but because they had to. It did not matter how bullish the story was for a particular company. If the speculator who owned it could no longer finance his position, the shares had to be liquidated. This forced selling creates a cascading effect, driving prices down regardless of fundamental value. You must therefore watch the actions of the central banks and the behavior of interest rates with the same intensity you watch your stock charts. Is the cost of borrowing rising? Is credit becoming more difficult to obtain? If the answer is yes, then the fuel for the bull market is being removed. The party is ending even if the music is still playing. A market that is being starved of credit cannot advance, and it is only a matter of time before it collapses under its own weight. To ignore the state of the money market is to sail a ship toward a gathering hurricane while admiring the color of the sails. These first three laws culminate in the fourth and final law, which is the ultimate principle of speculation. You must respect the tide. You must subordinate your own ego, your analysis, and your desires to the overwhelming force of the market's primary trend. My greatest successes came not when I was clever, but when I was patient and obedient. I waited for the market itself to tell me what to do. I learned to identify the great underlying trend, the line of least resistance, and to ride it until the evidence showed me it had turned. This is not a passive act. It requires constant vigilance and the courage to do nothing for weeks or even months at a time. The big money is not made in the day-to-day fluctuations, but in diagnosing and sticking with the big swing. I recall a time I was certain cotton was headed for a great advance. I had done my work, and my thesis was sound. But the market was stagnant. It wasn't ready to move. In my impatience, I began to trade, buying and selling, trying to force the market to act on my timetable. I was whipsawed back and forth, taking small but demoralizing losses. I was bleeding capital and confidence. Finally, I stepped away. I did nothing. I simply watched and waited. Weeks later, the tape began to confirm my initial thesis. The price broke out of its narrow range, the volume swelled, and the line of least resistance was clearly established upward. Only then did I enter. I bought my full line and sat tight, riding the move for a fortune. The market paid me for my patience, not my opinion. It rewarded my discipline in waiting for the tide to turn rather than my foolishness in trying to swim against the current. Therefore, this is your final task. You must quiet the noise in your own mind. The market does not care what you think it should do. It will do what it is going to do. Your job is to listen to its message. The message is written in the behavior of the general averages, the action of the leading stocks, and the condition of the money market. When all three align, the line of least resistance becomes as clear as a well-laid railroad track. Your work is to wait for that clarity. When the track is clear and the signal is green, you act with courage and conviction. But when the signals are confused, when the leaders are faltering and money is tight, you must have the discipline to stand aside in cash. To be a successful speculator, you must be a student of general conditions first, and a stock picker second. To reverse that order is to guarantee that Wall Street will present you with a bill for your education that you cannot afford to pay.